All right. How is everyone doing today? Anthony Hernandez, your mortgage friend here. I have a lot of conversations with new home buyers, people who have never purchased a home before and they're looking to get their first one. And a big question is, what does the monthly mortgage payment include? Which is your principal and interest, your hazard insurance, your real estate taxes, and your mortgage insurance. Now, when we talk about the breakdown of the monthly payment, often the number one question that I receive is, what is mortgage insurance? So I wanted to make this quick little video today and kind of explain what that is, why we have it, and is it possible to get rid of it? So just a couple questions like that. So first question is, what is mortgage insurance? Why am I paying it? Well, to be honest with you, mortgage insurance is it's a plan that you're paying for. As the borrower or the person who has the loan, you are paying for an insurance plan on behalf of the lender. Now, why are you paying for this? Really, it's because you're covering the cost that the lender might incur, if you can't finish paying for your house. So let's say you're a year into owning your house and you decide it's not working out and you just up and take a hike. You run, right? You go to a different state, you leave the country, or you just can't make your payments or anything like that. You're paying this insurance premium on behalf of your lender to help them cover the cost or the risk of, in case you can't pay for your house, in case you foreclose or you get behind on payments or anything like that. And so that's what that is. Now, there are a few ways that you can kind of use to get rid of mortgage insurance. If you make a down payment of 20% or more, mortgage insurance is not applied to your loan, which is great. Now, this is kind of where I think some misconception comes from, or misinformation. A lot of people think that when you do a conventional loan, you have to have 20% down. And that's not the case. Usually it's 5% down is a good number. Sometimes, depending on certain factors, you can do 3% down. And also, depending on other factors, sometimes it might have to be a little bit more than 5%, right? But 5% for the most part, with everyone that I speak to, a good majority of them, 5% is what you're going to need. So if you do 20% down on a conventional loan, that mortgage insurance is removed. Or if you don't do 20% down, but you've had the loan for a long enough period of time where you've paid off 20% of it, the mortgage insurance is also removed. But that could take, several years. The downside with mortgage insurance too, as someone who's making that monthly payment, is essentially that it adds, anywhere between $100 to $300 to your payment. It really just depends, and it's very specific to you and your situation. So it definitely can make a difference in your monthly payment. What I've seen in my experience is that if you have above a 700 credit score, usually that mortgage insurance is a little bit kinder to you as far as how much you have to pay. If you have below 700, anywhere between 600 and 700, that's still a great score to have, but mortgage insurance isn't as kind to with those conventional loans, in my experience, what I have seen. That's not always a guarantee. That's not for everyone, but in a lot of cases, in my experience, that's what that ends up looking like. Now, there also is a loan program that's offered here in Utah, and it's offered by a company called Utah Housing. And this is as of the making of this video. But they have a no mortgage insurance program, a loan program. And what's great about Utah Housing is they actually have, they do down payment assistance. Now, it's not a grant or anything like that. It's actually a secondary loan that you use as to help you cover your down payment. And they have a lot of specifications and rules that you need to fit into, but it's a great program to have, especially as a first-time home buyer, or even if you're just looking for some down payment assistance on, and it's your second time buying a home or anything like that. Great programs, always worth checking that out. But anyway, they have a no mortgage insurance program, and as of right now, as long as you fit into their guidelines, you can apply for that. And that some of those guidelines are having a credit score above 700, and then certain things on your credit really is what it comes down to. Now, the only downside to that is typically what you've seen in the past with those types of programs is because you do not have mortgage insurance, those interest rates tend to be slightly higher just because the lender, whoever they might be, in this case Utah Housing or anyone, typically their interest rates are slightly higher because they're taking on more of a risk. But that being said, it's still a great program to have because a lot of times you will actually save money per month, even though your interest rate might be a little bit higher. And you kind of have to weigh the benefits to that higher interest rate. So sometimes I've seen people who actually save quite a bit of money by taking a little bit higher interest rate. And the other thing that's important to remember that is most people end up refinancing anyway, whether in a couple of years or anything like that. And so that higher interest rate might really make a difference if you're holding on to that loan for a long time. But if you end up refinancing in a few years, it might not make that big of a difference. But again, everyone's a little different. Every loan program is a little different. It's very personal to you, and it will just depend. And so we need to talk specifics in your situation to kind of understand that. The other way that you can get rid of mortgage insurance is with those conventional loans. You can do what's called an upfront mortgage insurance premium payment. So you can actually opt to pay a lump sum at the beginning to pay off your mortgage insurance, which is great. And a lot of times for folks who have some cash to put for a down payment, sometimes they'll opt to take some of that cash and actually use it to pay off their mortgage insurance. And it will make more of an impact on their loan and their monthly payment that way rather than putting it towards the primary loan. So again, very specific to your situation and what you're looking for, but it's a great option if that ends up being what's most beneficial for you and your family and to get you into more of a comfortable monthly payment range. Those are kind of the big things. I'm looking at my notes here. Those are kind of the big things with mortgage insurance. It is something that always comes up, those questions. You do have to have it unless, like I said, you have a couple of those little loan programs there that you can find a way to get around it. But those are specific to you, your credit scores, income, all of that stuff. So, but the point is there's some great programs out there. And I hope that this helped explain a little bit more about mortgage insurance. If you have further questions about it or you want to understand more about it, feel free to reach out to me. Let's chat and we can talk about how that would affect your monthly payment and what options there are to maybe get around that or to get in the range that you're looking for your new home. So, or your second home or your third home or however many times it's been. So anyway, again, as always, purchasing, buying, refinancing, doing anything with a new home doesn't have to be scary, and it isn't if you have the right friend. Thanks, guys. Hit me up if you have any questions. I'd love to chat.